The reality is inflation is not going to weaken, it's going to strengthen, but the economy is not only going to weaken, but weaken much more than the markets expect. So the markets may in fact be right that the Fed stops hiking, but not because inflation comes down, but because the economy comes down, or because employment comes down and unemployment goes up. But as of now, everybody thinks everything is great. It's a Goldilocks scenario. People are looking for a soft landing where the economy weakens just enough to bring down inflation, but not enough to bring down corporate earnings, and you're getting this rally in everything. But it's important to differentiate between the rallies that are sustainable and those that are not. For example, I believe the rally in gold is not only sustainable, but it will accelerate. But what we're seeing in tech stocks, for example, or cryptocurrencies is not sustainable. These are head fakes, dead cat bounces, and at some point soon, I think we're going to see a reversal as markets become very disappointed in that reality doesn't match their fantasy, especially when it comes to inflation. In fact, one of the keys to why inflation is going to be so much stronger than people think is because the dollar is going to be so much weaker than everybody thinks, because the weakness in the dollar is what's going to be the catalyst for another explosive move up in commodity prices. And it's the decline in commodity prices that is helping to keep down goods prices, which is why everybody is so convinced that we've seen the worst of inflation and it's headed lower. But as commodities start to make new highs when the dollar makes new lows, that's going to throw cold water on that theory, and people are once again going to be afraid of higher inflation. But I think the Fed is going to be afraid to fight it because it's afraid of what that fight might do to a much weaker economy and much weaker labor market than what the Fed now expects. Now, because the real cause of inflation is the U.S. government and the Federal Reserve acting in concert with one another, where the U.S. government spends money it doesn't have, and then the Fed prints the money for the government to spend, that is why we have inflation. So if inflation is causing an economic hardship, and if the government and the Fed cause inflation, then it's the government and the Federal Reserve that are responsible for that hardship. Of course, Powell will never accept responsibility for the pain that he is helping to inflict, but it's the Fed and the government that are the reason that so many Americans are suffering this hardship. Inflation is a tax. It is how we are paying for government. And so if funding government is creating a hardship for the people who are on the hook for the tab, well, it's the government that's to blame. Powell claimed that price stability is the bedrock of our economy, and so it's very important that we have price stability. Now, if that is true, why does the Fed insist on 2% inflation? Because price stability means no inflation. Stable prices don't go up every year by 2%. Stable prices remain the same. That's what stability means. There's no change. Things are stable. Powell doesn't want stable prices. He wants prices to go up 2% a year, and he wants to pretend that a steady 2% annual increase constitutes stability. It does not. But also, if Powell thinks that price stability as defined by 2% inflation is so important, why is his goal simply to bring inflation back to 2%? After all, we've had so many years now where inflation is way above 2%. Why wouldn't Powell be targeting a lower rate of inflation than 2%, or maybe even falling prices? Because if we want to get the average rate of inflation down to 2%, given how much inflation we had in 2021, 2022, how much we're on track to get in 2023, in order to bring the average back down to 2%, we need to have some years where it's way below 2%. In fact, it would really help if we had some years where prices fell. That would be a big relief. But for some reason, Powell is against that. He doesn't want to reverse any of the price increases. He just wants to make sure that price increases continue just at a slower rate than the rate that they've been rising in the past. So in other words, if you think prices are too high, expect no relief from the Fed. All the Fed is going to do is increase them at a slower rate. But of course, it's not even going to accomplish that. In reality, the rate's going to increase. But in reality, the Fed has made no progress in the fight against inflation. Sure, we have seen this temporary reduction in the rate of increase in prices, but it's only temporary, because in order to really make progress on inflation fighting, Powell would have to change consumer behavior. We would have to have an increase in personal savings and a decrease in consumption spending. We're not seeing that at all. Credit card debt is at an all-time high. Savings are at an all-time low. Households are spending everything they earn and then some. And then, of course, you have all this government spending. So we haven't made any real progress in fighting inflation. It only appears that way if you're focusing on the effects of inflation, which are prices, rather than inflation itself, which is the expansion of the supply of money and credit, and that continues. Even if money supply growth has slowed, credit growth has not. Powell said that returning inflation to 2% is going to require below-trend growth for some time and a softening of labor market conditions. Now, that's just one of several economic concepts that Powell got wrong. First of all, in order to bring down inflation, you don't need to restrain economic growth. You need to restrain the growth of money supply. You need to restrain spending that results from money printing or excess credit. You don't want to restrain economic growth, because economic growth, true economic growth, results in an increase in supply. And you want an increase in supply. That helps keep prices down. But if you actually end up stifling real economic growth, you get less supply, and that puts more upward pressure on prices. But that's a concept that Powell doesn't really understand. The same thing with labor market conditions. We don't need a softening in the labor market. We don't need to put people out of work to bring down prices. We need to put more people to work. That's what we need. People working means we produce more stuff. The more stuff we have, the lower the price of that stuff. So when people are put out of work who might otherwise be employed productively, that actually makes it harder for the Fed to bring down inflation, because you're reducing supply. And of course, at the same time that a weakening economy reduces supply, the government stimulates demand with deficit spending. And since we have the biggest deficit spending ever outside of COVID going on right now, we are getting a historically large dose of fiscal stimulus. And that is interfering with the Fed's fight against inflation. If the Fed was really serious about fighting inflation, Powell would be demanding that the federal government cut spending. Instead, he's doing the opposite. And Powell made it clear that he wants Congress to raise the debt ceiling. He said it's important that Congress raise the debt ceiling. In other words, he wants Congress to keep on borrowing money and keep on spending. That shows that he's not serious about fighting inflation. Because if he really wanted to fight inflation, instead of calling for Congress to raise the debt ceiling, he would be calling on Congress to cut spending.